Hi everyone, my name is Parul Verma. Welcome back to my channel, Your Everyday Economics. In today's video, I will be talking about some investing myths and why it's very important for everyone to know about investing and personal finance. In 2022, the United States and the entire world experienced a drop in stock market. There was a prolonged drop in stock market prices and many investors thought that they have lost a lot of money and they started selling. The crash in stock market happened due to many economic factors. One of them was Russia-Ukraine war and Fed's intervention to control inflation by raising interest rates. The S&P 500 index, which is the benchmark index for US stock market, kept falling by more than 20% throughout 2022 from its peak in January of 2022. And you can see from this graph that with continuous interest rate hikes, the S&P 500 index is still showing a downward trend and it hasn't recovered from its 2022 January level yet. This must have scared you and you probably thought that investing in stocks is not a safe option. So in today's video, I want to bust this myth and I'll explain you why I feel that way. I feel financial literacy is critical for building wealth and it's very important for everyone to know how markets work and how we can make the correct decisions at the correct time without getting influenced by incorrect information. Even though I'm giving examples of US stock market in this video, it applies to any country with a developed stock market. So today's video focuses on two key elements. First is that investment is always done for the long term. If you look at the data over the long run, the overall stock market gave an average annual return of 10 to 14%. This chart from Google Finance shows that S&P 500 index, which is the benchmark index for the US stock market, has an upward trend over the long run. Sure, there are years when the stock market has fallen because of various economic factors, but if you look at the long run, you'll see a upward slope of the returns. So in this chart, you can see that there are two main dips in the investment returns in the S&P 500 index. One happened when the COVID pandemic hit the entire world, and soon after that, the market recovered. The second one started happening the beginning of 2022. The stock market kept falling throughout the end of 2022, mainly because of the Ukraine-Russia war and the tight monetary policy by the Fed that included interest rate hikes. So yes, if you just invested in the beginning of 2022 for short term and wanted to take your money out at any time in 2022 later, you would have lost your money. But if you take the emotions out of your investment decisions and leave the money for long run, at least for 5 years or so, you will definitely get a positive return. My second point in this video is that business cycles are real. What it means is that the economy goes through a series of ups and downs. Most stable economies experience both a boom and a bust. You can see from the chart that there are periods of expansions and recessions where the GDP and the stock market grow and contracted respectively. Every government, including the United States, tried to take corrective measures to bring the economy back on track. The government through the fiscal policy and the central bank or the Fed through the monetary policy take corrective measures so that the economy can achieve its long-term target inflation rate and the lowest unemployment possible. In the United States, the long-term target inflation is 2% and the target unemployment is around 5%. Over the long run, most developed and emerging economies have shown an upward trending growth. This trend line is steeper in the case of economies such as China and India, whereas it's a little bit less steeper in case of Western world, which has already achieved a desired level of GDP per capita. So yes, don't panic when the stock market is experiencing low returns or falling. Keep the money in there and you will see positive return over the long run. At that time, what you need to do is take the emotions out of your investment, wait and let the market recover. In fact, this would be a great time to start investing because everything is priced so low. So once the market recovers, you will actually see a higher rate of return on your investment. because you bought it at a lower price and eventually when you sell it, you will make more profit on it. What I would recommend is following a strategy called dollar cost averaging. For that, you should watch my video here where I will be talking about what it is and how it benefits and takes the emotions out of investing. To conclude the video, I would like to say that you should spend wisely and make investment your priority from the beginning. Most millionaires are just not born wealthy. They actually make correct investment decisions early in their life and build their wealth over time, and then they fulfill their dreams. Contrary to what we believe, most wealthy people do not buy a lot of expensive items, things that depreciate in value, such as fancy cars, but they actually invest the money in assets, the things that actually grow over time, such as a diversified stock market index and real estate investment trust. I will be covering more on that in my future videos, so stay tuned for that. I hope you enjoyed today's video, and if you like my videos, please subscribe to my channel and I'll meet you soon in my next video. Take care. Bye.